So, welcome everyone. This is officially our 11th annual Market Insight event, which we try to do every year. And the past 2 years have been remote due to extenuating circumstances, but hopefully next year, sick of saying that, but hopefully next year this will be in person. So I'm Andrew Rosen, one of the partners and president of Diversified. I want to thank you all for showing up today on all of our behalf. A couple items I'd just like to say before we get into the main event. I wanted to thank everyone for joining. It's been a heck of a crazy year, a wonderful year with a lot of exciting stuff here at Diversified. And hopefully in the next week or two, we'll have a couple more exciting news about our continual expansion and value we're trying to bring to our clients. This has officially been our best year at Diversified. And I feel like we say that every year. It's a big part due to our new office in Wayne, Pennsylvania. Those guys have been excellent out there, and we appreciate them. And I want to remind everyone that as we expand that and comfort everyone that I assure you we are doing so with the main focus to continually reinvest in our clients and making Diversified the top value-based financial firm in the country. That is our mission. As you know, here at Diversified, we don't just care about your wealth. We truly do care about your health and your happiness. But I don't want you to think that that means we're not giving full attention to the financial planning and wealth, which is why you guys come, and hopefully you stay for the fact that we truly care and want you to live your best lives. I'd also be remiss if I didn't thank each and every one of our beloved clients. Our success truly is your success, and we are truly nothing without you. We appreciate your continued loyalty and willingness to share what we got going on here with others. Sort of our secret sauce, and we appreciate that. So please know from the bottom of my heart, we are forever thankful for you. And now let's have some fun. So a couple housekeeping things, and I'll make some introductions. Questions, just type them in. I am going to proctor tonight a little panel discussion. So ask them as long as they are answerable. I will ask them here. We don't have to wait to then. We'll just keep it fluid and going. Today, they vary, but we won't have this go any longer than 45 minutes to somewhere in that 30 to 45 minute range. And I think that's about it. So let me make two wonderful introductions. Jack challenged me that I couldn't say his name right, so let's see how I do. First, we have Jack Janasiewicz. How'd I do?
Spot on. I love it.
Spot on. Awesome. He is a portfolio manager, lead portfolio strategist at Natixis Investment Manager Solutions, one of our partners, one of our many partners. He's responsible for providing insight and analysis on global economic and capital themes and their impact on portfolio construction and asset allocation. He has over 20 years of investment experience. Would you believe I remembered all this? So all this is to say he's a pretty big deal, and we're honored to have him here today. He works out of Boston, and I will skip the rest of his illustrious and long bio here, but he's excellent, and we're honored. Thanks for joining us, Jack. And then we have our one and only Mike Corwas. That's your intro, Mike.
I'm a pretty big deal too. I hope you know that.
He is a big deal. He is our chief investment officer. He is the man in charge, CFA. He's in charge of our $1.2, $1.3 billion in climbing of your hard-earned life savings that we truly thank you and you entrust in us. So we think it's nice to share some of our external resources and expertise and our internal in Mike, who runs our division here internally. So a lot of you don't get to see him because we keep him chained to a desk where he is looking out for all of our money, yours and mine combined. So, all right. I think that's my intro. So let's hop in and have some fun. So I will start. Again, type in any questions you have or anything you want me to hit tonight, please, because this is for you, not for us. And we will, oh, by the way, we will share this around. So if you happen to know anyone or that wants to watch it, feel free to share. But Mike, I'll kick it off with you. How's that sound? Can you, awesome. Do me a favor, start us off with a quick recap 2021 in the major asset classes in the markets. What worked, what didn't? Bring us up to speed and educate us here, please.
Yeah. So it's interesting, we sit here all, kind of partially remote in a hybrid environment. Everything's different, right? But with markets, it's been more of the same thing. It's potentially the third straight calendar year of double-digit global equity returns. So risk assets are driving, market returns. Like I said, equity markets, depending on, the global region, double digits, at least globally. In the US, large cap up over 20%. So risk assets are driving returns. Early in the year, it's hard to believe how long ago that was. We came into the year where bond yields were about 90 basis points on the 10-year, right? So, low yield environment. Not much has changed from that standpoint, but they pushed up to about 1.75%, which was a big deal at the time. Have kind of fallen back around 1.4, 1.5 today. But what that did was early in the year, we saw some of these cyclical sectors in the market driving returns, financials as an example, and as the year wore on and that bond yields faded back down kind of around that 1.4, 1.5 range. We've seen growth sectors kind of come back a little bit. And really at the end of the year, we're looking at pretty balanced returns from a stylistic standpoint here in the US. In the small cap space, small cap has underperformed. Large cap value stocks within the small cap space have done very well relative to the growth equities. Internationally, once again, it's been a year where US has dominated, or at least has led the international space. Most of the headlines internationally have driven around, their lack of recovery relative to the US, and we may touch on that today. But emerging markets have really kind of struggled, mostly on the back of China and their regulatory reform and just some of the things going on within that space. On the bond side, on the flip side, we talked about risk assets really performing well. It's really shine true within the fixed income space, as traditional long duration fixed income has really just had a bunch of headwinds. It's a combination of things. It's growth expectations picking up, inflation expectations picking up. So we've seen bond yields really rise, which naturally are a headwind to kind of long duration traditional fixed income. What's worked has been some of the shorter duration, some of the plus sectors, the spread sectors where you see bank loans, high yield, preferred securities, things like that perform well. But really the theme in 2021 has been as much as things have changed, a lot stayed the same, and risk assets have driven returns by and large here in 2021.
Yeah, and I like that, right? Things are ever changing, but yet when you look at the markets, so much is the same, right? And it feels like things are so different. Thank you for the insight. And Jack, so let's talk about everyone's favorite topic, inflation and inflationary pressure. So it seems to be one of the things that's affecting markets this year. Can you speak to what has driven inflation and whether you view it as more transitory or here to stay? And transitory, for those that don't know, means that it's sort of in and out, right? I mean, I guess that's the best way to describe it. It's not here as a long-term epidemic. So go ahead, Jack. Let's talk inflation.
So I'll start off by defining transitory and how we look at it, meaning it's not permanent. So we'll start there. And then I would also add in that, we certainly do expect prices to remain elevated, but we expect them to come down. They're probably going to end a little bit higher than where we started the COVID crisis. But I think the better way that we would describe the prices that we're seeing is more like a one-time step up. And that's very different than a prolonged and continued and sustained increase in price level. So that's sort of the general answer. But just to back up and sort of talk a bit about that, if we really take a look at what drove inflation, you had the heart of the COVID crisis, and the COVID crisis blueprint for most companies was the recession model, right? It was simply, hey, we're going to cut back on production and we're going to draw down our inventories. The problem with that, all of a sudden, to sort of stimulate the economy back, you had the Congress sending out, basically stimulus checks and all sorts of social safety nets. That caught the corporate sector flat-footed. They're playing for the recession, and all of a sudden, you send out all sorts of money that basically enabled all of us to continue to basically spend from our couches. So that mismatch, you had excess demand hitting at a time when supply was really being reeled back in. It's not surprising the result is a pickup in prices. Mix in the idea that COVID basically shut down a lot of portions of the tip of the spear on the supply chain. Think, Asia, Japan, China, and that's creating a shortage of goods as well. So all of that manifests into higher prices. Now, when we look at all the different line items within inflation, when we really deconstruct inflation, they all point back to the same thing for us. And they are largely functions of things that we call either supply chain issues, bottlenecking related issues, revenge spending related issues. To us, those are probably not going to continue in that same magnitude because A, we're going to start to see a lot of those excess savings and those stimulus sort of driven spending. That's going to start to fade away. So that increased buying power is going to fade, but we're still going to have the lingering backdrop with regards to the supply chain issue. So demand's going to cool off. We're going to still see a little bit of the lingering effects from the supply chain stuff, but over time that will eventually work its way out. We always like to say cure COVID or at least get COVID under control. And a lot of these issues that we're talking about from that wall of worry, so to speak, will all start to clear up as well. You're going to start to see people getting back into the labor force. So a lot of these labor issues that we're reading about, those will start to ease up as well. So the bottom line here for us, things will start to soften up as the COVID backdrop continues to improve. You're going to see a little bit of that pent-up demand starting to fade because we're going to be burning through a lot of that excess savings. That's going to ease up on the price front. Having said that, though, yes, we probably are going to settle in maybe at a slightly higher range. But for us, this sort of concern that you're hearing emanating through the markets that inflation is running hot, you're going to have to see the Fed aggressively hike. We think that's a little bit overdone. We're not quite as concerned or bearish, I guess, if you will, on the inflation outlook.
It's great insight. But so, Jack, you touched on it, and I'd like to go a little deeper here. So I ordered an oven in February and I received it in October, and I am probably one of the many tragedy tales from the past year. So how long does this supply chain issue in your mind last? And to that end, you said something interesting to me, which is that once people go back to work and cure COVID or COVID is more manageable, you anticipate seeing that supply chain issues they sort of dissipate a little bit. How are they related, right? Connect those dots in I guess all of our minds.
Sure. If we just think about it from pure supply and demand, right? You're the demand side of the equation. You're going out and you're trying to purchase the oven. Supply side of the equation, maybe your retailer that you're purchasing from, because they were sort of expecting that recession playbook to kick in. They had probably a limited inventory. Everybody's at home, everybody's looking around their house, working from their home, and they're saying, I need to upgrade this, I need to upgrade that. So all of a sudden you had this massive influx in demand hitting at a time when that supplier probably was drawing down his inventory and was probably looking out to say China or somewhere out on the Asian front. In Asia, ironically, at the same time is really going through what we call that zero tolerance policy for COVID. So they're basically shutting down everybody and telling them to go home until sort of they can see the COVID case counts getting better. So you've had almost a complete standstill from typical regions of the world that are producing these sort of goods. And so they have to come back online. These people have to come back, feel safe, want to get back to work, start the production lines up again, and then start the whole process over again. But it's this butterfly effect. There's a lot of interlink there because at the end of the day, shipping a good from Asia to the United States on these huge, freighters, that only happens a couple times a year and everything's connected. So when you sort of put a kink in one portion of that supply chain, the domino effect just falls and you start to see it reverberate through that whole issue. So, it starts at the tip of the spear. It's going to be the COVID issues in Asia. get that cleaned up, and you're going to start to see it continue to work its way through and finally manifest, and your oven finally shows up.
All right, good. I'm sick of ordering out, but now you can see why you're a big deal. That's a great it's a great explanation. Thank you for that. Mike, let's turn it to you for a moment. One of your favorite topics you always talk about in your videos, which hopefully everyone sees, puts out some great commentary every month and every week, is the Federal Reserve. So help us understand their target of full employment at 2% inflation, and with inflation sort of in the crosshairs and in the news, and what do you expect from them to do next year? So what moves will they do? What tricks are in their bag? And how does that then affect the economy or markets or what have you?
Yeah, for sure. So, I think taking a step back and reminding us that, reminding everybody why the Fed does what it does, right? They're not just picking interest rates. They're not just throwing money in and out of the markets. They're doing things for reasons. They're looking at data for certain things that they want to understand. So, right, their mandates are, low but positive inflation, typically a 2% target, right? They want full employment, right? You can debate that number. Pre-pandemic, it was roughly 3.5-ish on the unemployment rate, right? Last month it was 4.2. So we're working towards those numbers, but the Fed is trying to maximize those two things, right? As the economy is struggling, as long as unemployment's or inflation's under control, if unemployment's picking up, they can do things to manipulate interest rates and manipulate money supply to try to either accommodate or restrict the market. So in the end, you talked about what's in their playbook. Really, they threw everything at their playbook at the beginning of the pandemic. They kind of needed to, at least they felt that they needed to. And what we've been working towards really this year has been pretty quiet, right? It's been just constant updates of where are we at? It's been slow unemployment improvements. We've seen inflation ticking up. So naturally, when you start to see inflation pick up, people start to question interest rates at the floor, continued asset purchases every month. Is that the right policy? So that's what you're seeing a lot in the headlines. And then eventually it came to fruition in November at their meeting that they said, we're going to start to taper, which is increasing, right? So tapering isn't stopping or pulling money out. It's adding at a reducing rate. I think that's important that people understand. They're still accommodative. They're still adding money, but they're doing it at a reduced rate each month. So in November, they said they were going to reduce about 15 billion a month. That pace means that they'll stop adding money to the economy via those asset purchases in roughly June of next year. Why is that important? Is because it's been insinuated that they're not going to raise rates until their asset purchase program is done. So people look and say, okay, well, interest rate increases aren't on the table then until June of next year, and we can kind of work around that. Now, today, threw a little bit of a wrench into that. There's been some talk about increasing that rate and doubling that rate to 30 billion a month, which means they'd be done in March, which the natural reaction is, does that mean more potential interest rate increases next year? Are they going to tighten quicker? You heard Jack mention it earlier. So, as we look to next year, I think, clearly they're going to continue to taper. They'll finish probably some point between March and June. And I think the conversation then turns to transitory inflation, turns into where unemployment is inflation transitory? Is it starting to show signs of easing up? How confident are they? Because at the beginning of this entire process, when inflation started picking up, they were banging the table that they truly believed this was transitory, and they eased on that over the last several months. So it'll be interesting to see where they land in that opinion over the course of time. And that opinion is going to likely drive partially what their policy is next year. So what does that mean they're going to do? We'll see partially, but I think in the end, it's natural to expect that they'll probably start to tighten next year. I think you'll see expectations from 1 to 3 quarter percent interest rate increases. I'm kind of lean towards Jack, where I kind of have a hard time believing 3 is really possible. I would think, maybe they tighten once, maybe twice. But I think a lot of it's driven around, does the labor market continue to improve? Does inflation prove to kind of ease a little bit, especially in the areas that Jack's talking about, and supply chains, are they easing? One nice thing is we did see automakers speak to this at their last quarterly earnings calls. They were saying that supply chains are getting better. It's going to take time though. but we would expect that tapering ends at some point early to mid next year. Interest rates are back on the table. As long as things prove to continue to improve, especially in the labor markets, we do expect they'll probably raise rates once next year. But as we think about how we want to position portfolios, those are the types of things we're thinking about and expecting right now.
So thank you, Mike. So riddle me this, if you will. Every time the Fed threatens to raise rates, which when you think about it is just them saying the economy's doing well, jobs are good, corporate earnings are up, people are making money, right? Unemployment's down. It's a rosy picture, right? We no longer need to help. We no longer need to have daddy pay for our bills anymore, right? But every time they do that, which we all intuitively know they're not going to do this forever, nor do we want them to. But the markets seem to react or overreact, at least in my sort of intuitive opinion. What gives? What's that about?
I'll take that one, Jack. Is that okay?
Yeah, go ahead.
Yeah, I mean, it's partially a couple of things. One is, people are just emotional and they see all of a sudden we're restricting monetary policy. It's an emotion thing. It's a headline issue. It's something that we have to, our job is to coach our clients away from that, and why we don't necessarily, by the time the Fed's going to raise rates, you should be fully expecting that they're going to be raising rates. I think the expectation and markets are pricing that stuff in. Part of it also, Andrew, is markets are repricing expectations. So sometimes you'll start to see, you saw it earlier this year, and as the year went on, it changed. Markets are going to gyrate a little bit to what's working. If rates are picking up, they'll start to maybe favor some cyclical sectors for whatever reason. A lot of times because the economy is doing well. So some of those cyclical sectors like financials or industrials are performing well. And obviously part of it is also, now you're repricing some of these long duration growth stocks, big tech stocks, higher interest rates are kind of hurting their current valuations. So it's partially a couple of things, one of which is the emotional aspect. We know very well, we work through that every single day. And then the other part of it, I just think is naturally the markets are repricing themselves to kind of what are our expectations moving forward. So from my perspective, Jack, I don't know if you have anything else you'd like to add, but that's kind of the way I would think of it.
Yeah, I think, I always like to joke here, when I come in, what else can we overreact to today? I think that's sort of the epitome of that whole comment. But I would highlight a few other things too, Mike, and you hit on this with the tapering, right? It's just they're buying less. And I would actually highlight that comment in the sense that the market loves to think of the Fed as it's a binary outcome, they're either hawkish or dovish. By tapering, they're just simply less dovish. And I think that's very important for people to keep in mind. And, the fact that they're buying fewer assets over the course of the next couple of months, I would caution you, and we might get into a little bit of the wonky side of things, but think about it, right? When the Fed buys those assets from an institution like us, for example, we're going to get cash in return. What am I going to do with that cash? I'm not going to pile it back into the equity markets. I'm going to basically keep my asset allocation mix the same. I'm just going to go out and buy more of what I just sold back to the Fed. If it's an actual bank, the banks are actually going to get what's called credited on the reserves account. The reserves actually sit within a closed system. That money does not make its way out of that system. It basically helps banks settle transactions with each other. So this idea that the Fed is buying assets and that's propping up the market, that's sort of not true. It's just people don't understand the mechanics behind quantitative easing and asset purchases. And the last thing I would point to, if we look on the balance sheets, the amount of money that's sitting in what's called reverse repo, right? It's basically these short-term money market funds that don't have a place to put their extra cash. So they set up this repo line with the Fed where they're basically sending that money to the Fed. The Fed's paying them 5 basis points, and then they get that money back the next day. There's $1.6 trillion sitting in that. They're earning 5 basis points. If people really needed that money, I think they'd be putting it elsewhere where they're earning more on that, let alone the fact that there's $1.6 trillion sitting in that. So my point on that, there's so much money that's basically going unused right now. If the Fed slows the asset purchases down, we still have a ton of leftover money that's not being used right now to offset that. So, we hear a lot about tapering, but I think there's some concerns that are overblown with this whole thing.
Yeah, that's great perspective, Jack. And is there any, Jack or Mike, whoever wants to deal with this, is there any concern that with all this tapering and monetary policy and printing money that the U.S. dollar or the U.S. economy is no longer sort of the gold standard, the riskless asset class in the universe, and we go to something else, whether it's, and we'll touch it in a moment, the C word, right, crypto, or China, or some decentralized system?
I would say one thing, I'll just jump in real quick on that, when they started this whole package between, the Fed, the response cutting rates and the asset purchases, and then Congress, sending out the stimulus checks and all these concerns about the debt issuance, you hear over and over again that that's just going to destroy the dollar. If you actually look at what the dollar has done today versus where it was before the pandemic hit, the dollar is actually stronger. So the idea that everybody was pitching that all this excess spending and government financing would be the demise of the dollar, it hasn't played out, and the dollar is actually stronger. So, the bottom line is the dollar is still the currency reserve of the world. That's not going to change anytime soon. And the U.S. economy is still the best place to be. That's not going to change anytime soon either.
That's awesome. Okay, so Jack, I'm going to turn to you, because if you're wrong on this statement, everyone can be mad at Jack, who will no longer be a big deal, and Mike stays preserved as amazing.
So,
So
it won't be the first time.
That's right. Ask my wife. I
have two girls too.
Yeah, same. So anyways, so let's talk about let's look forward looking. So we talked about what's happened and what we anticipate. What does this mean for the markets? What do you anticipate? Can it keep going like this? Everyone gets nervous. We've had 66 all-time highs this year, but what do we see moving forward in the equity markets? And moving forward, we'll call 2022.
So we're still bullish on the markets for 2022. I know a lot of the street research and a lot of the Wall Street analysts are coming out with their forecasts. And I think, when we step back, and I'll talk about specifically just the U.S. economy right now, there's a couple of things that we look at that we think are maybe underappreciated. And the first one is simply the inventory rebuilding process, right? And we sort of talked on this at the beginning, where what was the blueprint for the COVID crisis? Well, it was basically your recession blueprint, which was cut back, don't produce, and then draw down your inventory. Well, guess what? When you look across the board, inventory levels have been cut so dramatically that they need to be replenished. And when you look at the amount of replenishing that needs to be done, it significantly adds to GDP growth. So just from the standpoint of businesses replenishing those inventories, which are still massively too low, that's going to be a catalyst. The second one, if I look at the housing market is on fire, right? You can look at it from a perspective of there's not enough houses out there. You have the millennials moving in and looking to actually start purchasing homes. You've got interest rates as low as they are. The list goes on and on. But if you actually put all this together and think about it, if you build a house, you got to fill it, right? You got to put curtains up. You got to buy rugs. You got to buy TVs. You got to buy ovens, all the things that go into that house. If you put all of that together, that's roughly 21% of the U.S. economy. That's 21% of GDP. That's huge. The housing market is going to continue to push higher. So all of those ancillary purchases that go along with that will be highly supportive for the economy. The third one, CapEx. You see all this cash sitting in the system, right? If I look at the money market funds for institutional clients that we have, there's north of almost $4.5 trillion sitting in money markets. That will eventually get put to work either through stock buybacks, through dividend distributions, or reinvested back in the business. My guess is, and we're seeing plenty of signs of it, it's getting reinvested back into the businesses. So we like to say one person's CapEx is another person's earnings. That's going to be a nice self-fulfilling prophecy, or nice circular reference there. That's going to support it. And the last one, we've seen a ton of excess savings accrue to state and local governments, because in the midst of the crisis, they cut back markedly. And guess what? We kept spending during that whole point. So all of a sudden, all these tax revenues from sales are starting to kick in. We're seeing state and local government revenues running about 8 to 10% above pre-COVID levels. What do you think state and locals are going to do? You think they're going to save that money? They're going to spend that too. So you've got state and local spending, you've got the CapEx cycle, you've got the housing cycle, and you've got the inventory restocking cycle. Those are pretty big catalysts for at least next year. That's why we think this economic bounce will continue, even if we get a couple of rate hikes from the Fed. Still not enough to derail this. So we still think the U.S. economy for the next couple of quarters, and I'm talking, into 2022 and maybe even a little beyond, still has plenty of tailwinds coming that are going to be very supportive, very optimistic still.
Well, I'm ready to run through a wall. That was awesome. That was the Janasiewicz, stamp of approval. So, Mike, I'm jazzed. What do we
Same
do?
here.
So now, right? I mean, so makes sense. It makes a lot of sense when you think about it from, someone puts this stuff into English for us. But you now are in charge of unfortunately not quite $4.6 trillion, just $1 billion+ here. And you have to make moves for our clients. So, and what are you looking at? Where's you and your team spending their efforts researching and moves you're thinking to be opportunistic, get ahead of this, take advantage of it? I know nothing's perfect, but tell us give us an insight into Swami's mind there.
So yeah, we'll look at this from a couple of different perspectives. First, you kind of ask yourself the equity to fixed income, perspective of which one do you prefer, which one would you want to be in, risk assets or more stable assets? And Jack kind of just answered the question for you, right? I mean, we still like risk assets. We still think equities, if you're going to have to make a decision on your risk tolerance, obviously your financial plan, obviously your income needs, your liquidity needs, how you feel, and all those things need to build into your risk tolerance first and foremost. But if we're going to sit back and just say, where do you want to be, equity or fixed income? To us, the equity markets are still a much more favorable space to be in. Jack spoke to how much spending is still potentially out there. And we talk about all the time with consumer spending being, I believe, 70% of GDP. People are spending money. There's money on the sideline. And when we kind of start to get into the nitty gritty of how we want to be allocated, we still prefer the U.S. over international. The U.S. dollar is still strong, but the U.S. is just, it's still ahead from a recovery standpoint. Corporate earnings projected, they're not going to be nearly to the growth level that they were this year, but this year was just, incredibly spectacular from a corporate earnings. They're still going to be very strong, mid to high single digits probably next year. So very strong corporate earnings. Positioning wise, like I said, weighted a little bit more towards the U.S. relative to international. We're still pretty balanced growth versus value when we look at the sector level. There are some themes that we like, technology, especially in the semiconductor space. That's a place, semiconductors used to be this cyclical industry, right? When the economy is doing well. But like when you take a step back and you look at, electric vehicles, AI, smartphones, 5G, and you see the big players in the semiconductor industry, it's just an industry that we see that's probably going to keep consolidating and growing. And, the NVIDIAs of the world, the Taiwan Semiconductor, these companies, they're just there for the long term. And as Jack said with CapEx, I mean, they're spending a ton of money to reinvest for the future. We just see that as a theme that's going to continue to play out. On the fixed income side, we kind of are sticking to kind of what we've been doing. We tend to approach it with kind of this core satellite approach. We're always going to have a semblance of core fixed income, some of the longer duration, traditional fixed income. We're looking to underweight that right now. We're looking at some of these plus sectors, these spread sectors, like the high yields, the emerging market debt, the preferred securities, the bank loans. Look, they carry more risk than the traditional fixed income. We just look at it as an environment that should be conducive for those sectors relative to some of the long duration treasuries or investment grade corporates. So by and large, really in summary, we're still conducive on equity markets, just like Jack said. We still see the U.S. likely to be the spot we're going to overweight relative to the global markets. We do like small cap a little bit going into next year. We're just a little bit careful in that space. And really in fixed income, we're leaning to some of these long-term, long duration core fixed income. We're leaning more towards the plus spread sectors, like I said, the preferreds, the bank loans, high yield, and emerging debt.
So two things you said, Mike, I want to hone in for a second. So one is less bullish on international, but give us your thoughts on on international. And you mentioned debt a couple times. Should clients and us and just Americans, I guess, be concerned with the amount of debt that we keep adding to our balance sheet? Is that it seems to be an unimaginable figure that is going one direction.
So I'll take the international, and Jack, you want to take the debt?
Sure.
That fun question, because that one's a toughie, but it's the international space, Andrew. It's a tough space. It's had a rough go of it. There's a couple things. One, developed international, unfortunately, it just has like a cyclical lean if you think about it, right? So with Europe, a lot of times you kind of think about the traditional sectors that comprise what Europe is, primarily more of those value-oriented sectors. It just hasn't been an environment that's been conducive, especially as they've had much harder time getting off the ground with lockdowns and economic activity. So partially that's been the tough headwind within international developed and emerging markets. China's obviously the main player, and China, they typically, it's funny how they do it, but when their economy is strong, when things are going well, is often when they make some big splash changes. And they did it this year back in July when they reined in tech. Ultimately, what they're saying is big tech within China is, the data is their data, right? And that's just how, you have to play it by their rules. So that shocked the market because some of the big names, especially the Alibabas, the Tencents, some of those big names got hit, along with, after school tutoring. And, not to go into this in too detail, but after school tutoring was a big thing that became a big private industry within China. And they essentially took it and said, we're going to own it as a public, essentially, entity, right? So a massive industry was just taken and ripped from the private markets. So these types of regulatory changes were just massive headwinds. And what I think you're seeing within international is, one, they're just slower to recover. So the US is just ahead in the recovery. That does present opportunities down the line, and we're not going to avoid international markets. I think we're just being more careful, picking our timing, looking at international and emerging as kind of more opportunistic. When do we want to really start to heavily weight there? Because when you look at our portfolios relative to the global markets, we are going to be a little underweight. But if you honestly had asked me today, next 10 years, the major asset classes where the returns are going to come from, the capital market assumptions are going to tell you emerging markets are one of the best opportunities. And I do fully believe that. I think you just have to be careful in the short term. But from my perspective, that's international markets kind of in a nutshell.
Right. And probably be patient, right? I mean, I would think.
For sure.
It's a marathon, not a sprint. Jack, hit us with the debt, and then I got one or two more questions, and we will close this sucker out.
Yeah, this will be, I'll make it quick. I think that the example I like to say is, let's say, Andrew, you're going to buy a house, and let's say you want to take out a mortgage for $500,000 for that house. If I turn around and say to you, well, no, I'll give you a mortgage for $1 million, and guess what? I'm going to give you a rate of 1.75% fixed. Would you take that? Probably a little bit more money than you need, but that interest rate is pretty impressive, pretty good. You could probably go and do something with that, right? Probably earn a little bit more money on the back of that. I know it's a little bit of a simplified explanation, but that's roughly how I think we need to think about the U.S. debt backdrop. I ran the numbers as of the end of last year, so I'd have to update them, but roughly the average interest rate in our debt was around 1.78%. So the absolute number is certainly a big number, but the cost of financing that is very small. And I think that's where people, might miss the boat on some of these things that we talk about. The debt to GDP numbers, the headline that we always hear about, but the interest rate that we're paying on that is extremely low. The issue then becomes, are we doing good things with that incremental money? Are we doing productive things that are going to help the economic growth front going forward? That's another topic. But the point being, when you're financing these debt levels at such a low rate, I think that's the more important one. And it just becomes, roughly about 3 or 4% of the total US GDP. So, listen, at some point, will it matter? Probably. Right now, it's still pretty cheap.
Yeah, got it. It's not in your periphery as a major concern.
Absolutely correct.
Got it. All right. We can't finish tonight without bringing up everyone's favorite word. At least my friends who know nothing about the markets or anything seem to love this thing called cryptocurrency and the unbelievable rocket ship it's on. And maybe it's real, maybe it's not. Who am I to say? You're both much smarter than I and more in tune. So what gives? What is this? Is this thing real? Is this worth what it is? Should we be dumping everything and going into cryptocurrencies? Whoever takes this one, take it, because I'm missed by it, and you know, my head spins.
I'll take a first crack at this one, Mike, if you want. So I'll tell you guys, I work, I'm one of the older guys here on our floor, and a lot of the young bucks here are trading the cryptos, and we always have these conversations, and they basically tell me that I'm this old curmudgeon and I don't get it. So we'll start with that. But I will say though, when we have these conversations and I ask, well, why should I be buying crypto? I get three responses, right? The first one has always been, well, it's a store of value. And I say, okay, to me, a store of value is something that doesn't have an annualized standard deviation of 65%. That to me is not a store of value. I want something that's constant, that doesn't move around, that I know will always be there. Bitcoin, and I ran the number before I jumped on here, Bitcoin's volatility is about 65%. So that to me doesn't hold up. The second thing they always tend to tell me is it's an inflation hedge. Well, I asked them just the other day, but Bitcoin's off close to 30%, I think, in the last couple of weeks. Does that mean that we're now in a deflationary environment? Because if that's an inflation hedge, it should be going up. And I get the eye roll and they walk away from me. So it's not an inflation hedge either. The third one, and we sort of touched on this a couple minutes ago, they tell me with all this printing and all this money expansion, the dollar is going to basically devalue, and this is a hedge against dollar devaluation. Well, guess what? The dollar is actually stronger than where we were previous to the COVID crisis. So the concept that the dollar is going to be destroyed, I don't think that holds any water either. So to wrap all of it up, my last comment to them is always, well, does Bitcoin make my life easier? Can I go down the street and pay for my lunch? Can I get a meatball sub down the street paying Bitcoins? No. So my point on this is, listen, I understand the crypto backdrop. To me, if you want to be involved, it's a momentum trade because more and more people want to get involved because they see prices going up. I still have yet to see the long-term benefits of it. I know this is where a lot of people get upset at me, but as I go through what's the utility with regarding cryptos, I don't see it yet. So maybe it'll come in a different form, but the current form that we're seeing right now, I still don't see the benefits. Why can't I just swipe my MasterCard or Visa? And it's basically, I don't have to carry the cash. It's going to be that quicker. I don't need the anonymity. I'm not trying to do any illicit activities, that sort of thing. So, I still have a lot of questions behind it. But again, bottom line, I get it. It's a momentum trade. That's a style of trading. It's a style of investing. If people want to use that, that just simply means you hope someone's going to be willing to pay a higher price than you are. And that to me is, if this continues to be adopted, that's one way that can work out. But other than that, I'm still waiting to see what the actual utility is on a day-to-day basis. I don't think we're there yet.
That makes sense. That's Crazy Willie, my freshman year Econ 101 teacher, told me supply equals demand, right? So, Mike, anything to add there? And then I'll let you finish up with your statement to investors for the next year.
What I would say is that, Jack hit the nail on the head as to why most people, the average person, is buying crypto. I think one, the average person is probably buying it because it's going up and that's all they care about. Two, they're buying it because they're being told that it's, it's this decentralized thing and, it's anonymous and it's an inflation hedge. It's like gold. Well, it doesn't act anything like gold. Let's be very clear. If you take a step back and you ask yourself, what are the people who are spending all their money and time in this world are doing, right? The venture capital people love the blockchain technology behind the scenes, right? That underpins everything that crypto is, right? The decentralized nature of it, the way that you can code something and create rules behind it, and that this mining idea kind of creates this entire universe, that seems like it has potential use down the line. I don't know what that use is, but I think that's where people should be focusing their time is what does blockchain mean, and what does that type of technology offer in the future? Whether you hear decentralized finance, you hear things like that. There's all kind of uses that potentially could come to fruition, but today, no one can practically tell you exactly what that is. It's in very much its infancy stage, and it's very much in that venture capital phase right now. The way we look at it is 65% annualized volatility. Thank you, Jack, for that number. Is not something our clients can honestly withstand. And if they can, we have to have a conversation about what the objective behind it is. Maybe it goes up, maybe it doesn't. I can't tell you, and no one can really tell you the intrinsic value of what Bitcoin should be, right? When we work with firms like Natixis and the managers that underlie them, they buy companies that they can value, and they understand their cash flows, they understand their earnings, they understand what their value proposition is, the industry analysis, all of that, right? And they can tell you what their price projection is. Anybody who throws out a price projection on Bitcoin, I don't know where they're just throwing darts at a dartboard, to be completely honest. So that's where I struggle with. I don't know why our clients necessarily need that in their retirement portfolio, their income portfolio. Where somebody could think about it is within the confines of a speculative portion of their portfolio. If you want to take 5% of your net worth and do something on the side and understand that it can cut in half or it can triple overnight. That is where maybe the practicality is. But from the standpoint of 65% volatility, where does it fit in our portfolio? How does it correlate with our assets? You find that it really just correlates more so with the NASDAQ, right? Growthy tech stocks. That's really, it moves in line often with how those markets work. But from our perspective, it doesn't add enough value to the portfolio. And we don't see where that fits beyond maybe a speculative long-term piece that you kind of keep off to the side.
Awesome. I love it. Okay. Final thoughts or investment advice for looking forward, Mike or Jack? Why don't you each give us your final comments there, and then we'll let all these wonderful people go. Give my closing remarks.
Sure, I'll go quick. Based on our conversations with our clients, I think people are still underappreciating how good next year may actually be. Surprise to the upside.
Yeah. I read Jack's piece not too long ago. I cracked up because he said every analyst comes out and says next year 5 to 7%. Everybody says that, right? He's like, I'm not saying that, right? And I think it's a very, he sticks by his guns, which I always appreciate. I agree. Keep a long-term perspective, understand what you're owning, why you're owning it, understand that, the emotional part of it's always there. And you reach out to us if you have any questions, but, the things we always sign off on are keep that long-term perspective, understand what we're doing and why we're doing it, and go enjoy the things you actually enjoy doing.
That's great. That is great. Jack and Mike, I know your time is valuable, and we sincerely appreciate it and you donating it to us tonight. Mike, we are honored to have you at the helm, continually looking after all of our clients and friends' well-earned and hard-earned money. So thank you. I think it's nice for them to see behind the curtain here and there, and we believe in transparency and communication here and education. So I learned a lot. Hopefully everyone listening and everyone we will send this to learned a lot. To our clients, we love you. We are forever thankful for you. We are, like I said when we started, our success is your success, and our goal is to have you live your best life and be a lifelong partner along the way with you. So with that, I will wish you all a happy and a healthy holiday season and a healthy new year, a prosperous new year. I'm going to go shoot darts behind me, like Mike said, and see if I can figure out this Bitcoin thing. And with that, I'm Andrew Rosen here, and on behalf of my partners and all our colleagues here at Diversified, from the bottom of my heart, thank you, and a happy and a healthy. So thanks, everyone.
Take care, guys. Thank you.
All right.
Take care.
Bye.